That works. And today, we even see some insurance companies that have done 20-year terms. In fact, it's a very common product today. So with a 20-year term, we would take 20 years and average the cost for that time. And now the nice thing about a 20-year term is your cost is nice and predictable for a good long time. Of course, it costs you more initially than it would have to buy that 5-year term, but you're not going to have an increasing cost on a regular basis. This is likely going to give you enough insurance to cover out until your mortgage is a fairly small amount. And at that 20-year mark, you can decide whether you want to renew the coverage, that is, whether you want to go to the next term, or whether you want to drop the coverage or somehow modify the coverage. The modification options vary from insurance company to insurance company. There's no standard rule for that. Now, at some point during that term coverage, you might even decide you want to convert your coverage into permanent coverage. Anytime we come across that idea of conversion, it means that we're converting to another sort of insurance product. In this case, we'd be converting from an individual term policy into an individual permanent policy, normally to universal life or whole life. And that conversion is done without any evidence of insurability. So the insurance company said back here, we're happy to take on that risk. We're even happy to take on that risk if you decide that you want to convert into a permanent product later on. Even if you get sick over here and you want to convert over here, that's fine. You bought back here, and that's the risk we took on. We don't care that you got sick here. Okay? So now, we have this term insurance in place. You get to the end of your term. You can renew if you want. You can convert at some point. You might wait till you're 75. Just let the coverage lapse at that point. With most term policies, you'll find that there will be some deadline for it, some point at which you can no longer carry on your coverage. Age 75 or 80 is fairly common today. We even find today some insurers who've gone beyond a 20-year term. A couple of insurers are already offering 30-year terms. There are a couple of insurers who offer a pick-a-term product where you could buy a term to exactly match maybe the number of years left on a mortgage, as an example. So that's really term insurance. The structure is simple. There's no cash values associated with it. There's nothing to it except paying the cost of insurance plus a little bit of expenses. The insurance company has estimated what their needs are based on mortality tables, and they're going to collect really just enough premium here for them to make a little bit of profit and to pay the cost of the death benefits that arise during the time that they have these folks insured. Now, there are a couple different death benefit structures available with term insurance, 3 of them in fact. The most common by far is a level term structure. A level term structure, you buy your term insurance, you buy a $250,000 term policy, and that's always what you have. An increasing term policy is relatively rare. There are not a lot of companies today offering an increasing term policy, but an increasing term policy or increasing death benefit within a term policy would see your death benefit increase usually to keep pace with inflation where it's done. So it keeps pace with inflation. You would have maybe 250 this year and 255 next year and 270 next year and 280 and so on. Your death benefit would always keep pace with inflation. Of course, your premiums would increase with that type of product. A decreasing term product is actually very common. It's not sold very much on an individual basis, but lots of people will buy a decreasing term product when they acquire their mortgage. So you buy a mortgage, you know that you're going to have a decreasing need for insurance over time. At the same time, you buy a death benefit that's going to decrease at the same pace as your mortgage. Bank-sponsored mortgage insurance, which is not individual insurance but rather a group creditor product, but that bank-sponsored product is a decreasing term policy. So who buys term insurance? Well, term insurance is so inexpensive that it is the most common type of insurance sold. You'll find that probably the majority of your clients will have some term insurance somewhere in their portfolio. And the reason that it's so common is because it's inexpensive. People buy term insurance for a number of reasons. They buy it to cover off a debt. They buy it to cover off a short-term need for insurance, such as the need for insurance that a family would have when mom and dad are in their 20s or 30s, the kids are relatively young. We know at that point that we need a fair bit of coverage in place for the next 20 or 30 years. We buy enough insurance to match that period. We buy a large amount of term insurance, and maybe we buy some permanent insurance to go along with it, but the term insurance is going to fill most of the family's needs for that period. If you're not looking for any kind of investments, you don't need any kind of tax-deferred growth, you have limited disposable income, you have a short-term need, those are all the situations where term insurance is most often used. So there's not much complexity to term insurance, but you certainly have to know this product. It will be something you'll deal with day in and day out. It's such a common part of the insurance industry. Everybody touches on term insurance at some point along the way. Good luck with your studies. I hope that this has made sense to you, and I hope that you are able to join us for a future video in the LLQP video series. Thank you very much.